What's up, guys? It's Rey-Jay back with another video. And in this one, I want to give you guys a very important warning about the economy, as I believe there's going to be a recession coming, regardless of what the Fed is telling us right now. But just know that I am not a financial planner, so take nothing I say as financial advice. And also, if you guys can, please check out my Mumu link. If you deposit $100, you're guaranteed 5 free stocks. If you deposit $1,000, you're guaranteed 15 in total, not to mention an 8.1% APY on uninvested cash. The offer ends in just a couple of weeks. Anyways, now let's talk about the market. So, what's happening with the election? What's happening with all this stuff that's going on? I'm going to try to be kind of unbiased when I say the things I have to say. So, the market's in a very, very interesting phase. We have seen the market hold up very, very well because you have to remember the saying that goes: the stock market is not the economy. The economy could be contracting, but the stock market could remain elevated if earnings are decent. The latest earnings that have come out have been mixed. Guidance hasn't been as strong as what some of these investors were looking for, but nonetheless, they were not that bad. Despite that, we did see some negative reactions because of guidance, and that's why the market is starting to slow down. So earnings have been one of the factors holding the market up. And now that things are starting to not look as great in the eyes of investors, that's exactly why the market has slowed down a bit. So the question is, what's going to happen with this election that's approaching? Is the election going to cause anything that's different? Yes and no. So yes, because each of the different candidates have different policies and they're going to be priced in differently. But at the same time, I'm saying no because I believe there is something inevitable, which means that there's most likely going to be a recession, regardless of who ends up winning. And here's the reason why. So you have the Fed, we have Jerome Powell, the Fed, they had this pandemic that happened here in the US. It was very, very difficult for everyday Americans. So what they did is they started to just increase the money supply over and over and over again and increase government spending. In doing so, this led to spending practices that were not sustainable, and the government has slowed down since. But here's the thing: there's a big but. With the amount of government spending that was happening and the increases to money supply, and then many other different factors out there, such as like wars and all these other things. So there's a bunch of different factors. It led to a surge in inflation. The surge in inflation led us to almost double-digit inflation at one point, and then that's why the Fed has been raising rates for quite some time. The Fed was tightening on policy, and you have to consider the fact that when they raise rates, it does not mean that the whole economy is just going to collapse immediately, because these effects could take 12 to 18 months depending on the timing and different factors. So I believe we're seeing a delayed reaction to the rate hikes that were happening because of how much stimulus there was. There was so much stimulus, so the reaction is delayed. Also, I don't fully trust every piece of data that's being reported, as data could be very biased, and they could be trying to make everything look better than expected because of the election. So that's another factor that I just want to account for. But what is my view? What do I think is going to happen? Here's my answer. Okay, it's very simple. There's going to be some hardship coming. I believe because interest rates are still elevated, and even as the Fed enters a cutting cycle, they typically don't cut unless they believe it's necessary or they start to see signs that things are breaking. The Fed told us that everything was okay in 2008. They were telling us that everything was okay, inflation was transitory, when it really wasn't. It took years for them to get the numbers to look better. And now they're telling us that everything is okay. There's a soft landing that's potentially coming, which I actually disagree with, because I think what's going to happen is this. I think that the data is very delayed and very biased, and there is a lot happening on the back end. I believe the Fed has to manage inflation, unemployment, yields, and all these different factors. And I think that the increase in yields right now is something the Fed is putting the Fed in a very, very dire place. So managing yields, inflation, unemployment, all that simultaneously is very difficult. And I think that the high interest rates are going to lead to weaker job numbers, more unemployment in the US. If you look at the latest numbers, they're actually looking relatively weak. Just look at manufacturing payrolls right here and the others. And even though the unemployment rate is reported to be like just as expected, we are seeing unemployment slowly increasing. It's on a bit of an uptrend. So here's my view. Unemployment's going to go up next year, guys. We're going to be looking for a lot of increases in unemployment because of the fact that interest rates are still elevated. Remember, the reaction is very delayed. So when unemployment goes up, we're going to see a lot of economic contraction. And I also think that the effects of having rates this high for this time will slowly hurt the economy more and more. Now, it's also possible that the bonds market is going to be very involved in this because the government makes money through two main things. They either borrow money or they basically like tax us, whether it's through tariffs or just like income tax and things like that. So, you know, regardless of who wins, I still believe that yields are going to continue to go up. But what the bonds market is thinking is that we might see basically the guy on the right winning. That's what the bonds market is kind of like thinking. So what they're doing is they are pricing in the possibility of the government seeing a shock. So when there's a big shift in policy, such as like tax cuts or something like that, there's going to be shocks to the economy. But the economy does adjust as time goes on. That's like something that's talked about in economic theory. But just know that during these shocks, the government has to try to offset things. So tax cuts, yeah, they have their benefits. But initially there might be a little bit of a decrease in governmental revenue before things start to normalize as time goes on. So initially during the shock, there's going to be a disruption, and when there's this disruption, the government has to basically start, or they think the government's going to be issuing a lot more treasuries. So now the government's going to be borrowing more money. Okay, that's basically what that means. The government borrows more money to, use more money. But when the government borrows money, there's interest. That is basically what's inversely correlated with treasuries. That's going to be our yields. So yields are expensive. They're going up and up and up. And you're seeing the effect of this. Look at the last few weeks. As we get closer to the election, this is starting to go up more and more and more as the market's kind of pricing in possible like tax cuts, or it could be other factors like that. So this means that the interest that the government's paying on these loans is crazy high. And it's becoming harder and harder for them to pay it, which is why they might need some kind of reset. So we're at the highest yields have been since like for a long time. If we actually go back to, let me just pull this up real quick. If we go back to the monthly chart of the 10-year right over here, you will see that we're actually at some of the highest yields we've seen. If you look at like the past year, they're at some of the highest levels we've seen since like 2008. And if they do continue to rocket, if we get past the 5% area, not going to be too good. That's when things become dangerous. So we're not quite there yet, but there is a risk of it as yields continue to climb. If they start to skyrocket, there might be a great reset. And that could be one of the reasons why the Fed kind of rug pulls us into a recession because of high inflation, all these other factors. It's also very possible that the effects of interest rates are irreversible in a way where, regardless of if it's Kamala Harris or President Trump, whoever wins, right? Whoever wins, whether we get a President Harris or President Trump, whoever it is, okay, you guys can support whoever you want. It's up to you. I'm completely okay with that. But I just want to say this. Regardless of who wins, the high interest rates are still going to have their effect, and we're going to likely still see the effects to our economy. So there's still going to be that recessionary contraction that's coming early next year, regardless of who wins. I believe that's the most likely case. And I believe the Fed is not giving us the full information because of the election. It's also because the Fed has a history of just trying to calm everyone down. So please be very, very mindful of that. Did the Fed bring inflation down? You could argue, sure, maybe they did. But here's the thing. That does not mean prices are going down. It just means that the rate at which prices are going up is what's slowing down. So prices are still elevated, but they're not going up as fast as before. That's all that inflation slowing down means. That's all it means. So prices are still at these highs. Americans are kind of struggling. I mean, they're really struggling, unfortunately. And it's very hard for me to say that. And I don't think that everything is just going to become beautiful right after the election. I think that the effects of what has already happened is going to still hurt the economy and the jobs market. Elon Musk was talking about how even if we do get like a victory of the guy on the right, you have to remember that there could be some economic chaos initially, but it's going to be temporary. And then eventually things will be necessary just to bring down spending and such like that. So I do agree with him. There might be some initial chaos in the beginning. Not just Trump. If Harris wins as well, it'll be the same thing. Um, but excuse me, there could be different reasons for it, right? Under Trump, we have different policy changes that could also contribute to some initial chaos, at least to something different later on. I'm not trying to get political when I say this or get into deep policy, but I'm just trying to say that. So that's why I was getting into like the point of how like if you have a politician that's like shifting policies in a very very drastic manner very quickly, there might be some like chaos initially, and then things do normalize over time, and it could be a lot better over time. It could be worse. It depends. But in that case, whether things get better for the longer term, what's the cost of that? You have to think about it. What's the cost to get things better in the economy for the long term? There might have to be some short term pain. You guys understand what I'm saying? So that's the reason why you want to be very very open minded about that. So I hope that my way of explaining this was very simple to understand. I'm trying to make it very simple. So we are entering a tough time, guys. I'm going to be 100% honest and blunt about that. What does this mean for the stock market? Well, I believe the market's going to see a corrective phase, whether it's because of the recession right now or if it's something that's going to happen like a few months into the future. I don't know what the main time frame is going to be, but I do want to say this: SPY has a lot of gaps to fill. We are eventually going to see most likely the 550s, if not the 530s, at one point. We still have a lot of gaps to fill down here. So that's one reason why. The economic contractions is another reason. And then also earnings are starting to slow down. Earnings are what we're holding the market up now. They're not looking as strong as what they were looking like before. So we have these gaps down here, a lot of gaps to fill below. I think that there might be a corrective phase that's coming. And I don't know if the stock market is going to see the correction just because of the election or after the election, or if it's going to be delayed. Like we get a small dip, we recover after the election, then we get a big dump in early 2025. I don't know which one it's going to be. In all honesty, it depends on the election, the factors that we get. But just know this, okay? Regardless of the stock market, regardless of what's happening with like Tesla, the QQQ, and the others, Tesla could come down to fill this gap after the election if we get a rug pull. If not, we could try to rebound. We'll have to see about that. The QQQ, we have these gaps below to fill as well. We'll have to see if those end up getting filled too. So we'll see about all of that. So give this all the time it needs. There is going to likely be a corrective phase coming either after the election or maybe it's going to be later than that in early 2025. So we will see. But I'm just here to give you guys a warning about it. Regardless, the recession is coming, guys. And that's why I want to give you guys a warning about it, that you should not fully trust everything that the Fed is telling us. That's my honest view. I believe that there's a delayed effect of the interest rates being elevated and it's taking time, but they are slowly starting to show their effect. And eventually it's going to become a lot more profound. So keep in mind, guys, that there's going to be contraction and unemployment is going to go up. So we might see a lot of job loss. I hope that none of you lose your jobs if you have a job. I hope the best for all of you through these hard times that are coming. I do believe that if there is a recession, there's going to be like a reset, and we will recover. We're going to be looking for great growth afterwards, but this is just a short-term thing, and you guys have to be prepared for these hard times that are yet to come. So if you want to adjust your spending, the way you spend money, what you do with your guys' like savings, whatever you guys want to do, if you guys want to make those adjustments, this is the time to do it. Okay, because you have to be prepared. A lot of people may be caught off guard. A lot of people may lose their jobs. A lot of people may be hurt a lot more. And I'm just here to give you guys my voice. My ability to help you would just be to let everyone know the truth, the uncomfortable truth that the Fed is not telling us. So the government's way of spending money, making money is what could lead to a recession, not to mention the high interest rates and all these different factors. Regardless of if we get a President Trump or a President Harris, it doesn't matter. I think it's still coming anyways. That's what my view is. I think there's going to be a correction coming to the markets, whether it's now or if it's going to be coming maybe early next year. Regardless of that, keep that in mind. Keep my warnings in mind, and we will see how things end up going. Don't panic, though. Remember to stay calm, cool, and collected. And we have to be playing chess. We're not playing checkers, for playing chess. You want to see many moves ahead about how things are likely going to come out, and then prepare just to be safe. You understand what I'm saying? Prepare just to be safe. All right. Anyways, that's it for my video. I hope that this video was insightful and gives you guys, a warning about what's to come. And I just wish the best for all of you guys. I really appreciate you guys for your attention. I want you all to do well, and I want you guys to be prepared for what's about to come. All right. Have a great day. Enjoy the rest of the weekend. I'll be back tomorrow for another update. Until then, have a great day and peace out.